Good morning. Welcome to Market Monday for February 19th, 2024, and a happy President's Day to you all. Well, that didn't take long. We rally 14 out of the past 15 weeks, 5% straight line up since the start of the year, get a 1% down day, and here we go. That's not your typical run-of-the-mill red banner. That's giant. I mean, look at that font. All caps and bold? Wow, must be a nasty bear market, bumping up against all-time highs and all. Same as it ever was. While we're at it, it seems one of investors' favorite pastimes is talking about the performance of the stock market in terms of points on the Dow Jones Industrial Average. While the S&P 500 stock market index has been the dominant index recently, the Dow has a much longer history, and as Mick Jagger said, old habits die hard. While describing the Dow in points makes for great headlines and lots of clicks, it really doesn't do much beyond that. Why? Let's go back to a very challenging time, the very beginning of COVID. Now that we've almost fully recovered, and it turned out to be a quick recovery from the COVID low due to lots of government support, it wasn't always that clear. Remember this? March 9th, 2020. Almost 8% drop in one day. 3 days later, a 10% drop. Then 4 days later after that, an almost 13% drop in one day. Here are the corresponding point drops along with it. Now, if we put those same point drops compared to today's Dow index value of, let's call it 38,250, we see this first drop here would have been just 5.25%. This drop would have been 6.15%, and this big 13% drop would only have been a 7.83% drop. Obviously still brutal one-day declines, but a lot different. Another quick example, let's take a random number, 1,000 Dow points. That would be a 2.61% drop with today's index value. Same 1,000 points at the start of 2020. Almost 3.5% drop. Start of 2015, a 5.6% drop. And on and on and on. Point is, folks, thinking about the stock market in terms of points doesn't provide the context we need to properly understand the behavior of markets. Speaking of context and history, remember those nasty drops I was just talking about? Yep, these ones. Well, there were some strong up days too, but all that considered, the eventual peak to trough decline in the S&P 500 was just about 34%. But guess what? All that chaos, uncertainty, fear, and yes, even panic, has now been reduced to this line right here. Just a line with a red number in it. Global financial crisis, just a line with a red number in it. Look at all the other red numbers. Look at the black ones. This is another challenge, is to absorb or fade the near-term gyrations of the markets to reduce them to lines on charts. After all, it's going to happen, whether we like it or not. And let's do this so we can understand the history and context. Drawdown since 1970. Over here, we can see it's pretty rare for the market to have 20% drawdowns in the span of 2 years in a row, like we just had. And more often than not, the market goes years without a 20% drawdown. Just history and context. And today we'll leave you with, have you ever heard that saying, the simplest explanation is often the right explanation? With so much complexity in the economy and markets, GDP, inflation, employment, sentiment this, manufacturing that, we find it helpful to literally turn all that off and step back. Look at this. We talk about Social Security as the federal government's largest expense. Here's the Congressional Budget Office, or CBO, actual Social Security expenditures in 2022. It's a little over $1 trillion, as we've talked about many times. This year, it's expected to be almost $1.3 trillion. Then it goes out another 10 years, and in 2032, the estimated Social Security outlay is $2 trillion per year. That's almost $1 trillion more per year than we had in 2022, going into the economy every year, and likely growing beyond that. Speaking of, here's what the US population may look like. More people, more dollars, more commerce. Have a great week.